My name is Dick Patten. I'm the president of the American Family Business Foundation. Our mission is to help that hero of the American economy, the American family business entrepreneur, to survive and thrive despite the choppy waters of today's economic, regulatory, and tax environment. Of chief interest to us is the federal estate tax, which is, of course, today's subject. And we hope to shed some light on the effects of the estate tax on family businesses, on jobs, on wages, on GDP, and on tax revenues. The estate tax, of course, is a large confiscation of America's most productive capital in the economy. But it is also, and as you will hear personal testimony, it is the great hurdle to the survival of family businesses and family farms from one generation to the next. And you will hear personal testimony of precisely those facts today as well. Now, while we all know that the estate tax is an issue that is fraught with emotions on both sides, it is our desire to take an original look at this issue and to bring some new facets of this complicated issue to your attention so that you can look at it and think about it and talk about it or write about it in ways that you have not seen it before. It's my hope that you'll leave this luncheon with a fresh perspective and with these tools, and to widen and deepen the discussion. We, of course, know that the estate tax, this is a year of great consequence, where at the moment it's 0 and it's on the verge of going, we all know, to 60%. And the big question on the table is what is going to happen to it. And this discussion, these tools, are going to be very much in the middle of all those discussions. I would now like to introduce to you our first speaker. And our first speaker is a guy who probably isn't a stranger to any of you in this room, Dr. Douglas Holtz-Eakin. Doug is he's the president of the American Action Forum. I think many of you know that he was the director of domestic and economic policy for the John McCain presidential campaign. Prior to that, he was the 6th director of the Congressional Budget Office. And in his role there came to be respected by everybody in every house, on both the House and the Senate, on both sides of the aisle as well. Doug, prior to that, was the chief economist for the President's Council of Economic Advisors. Prior to that, he was the senior, I think it was trustee professor at Syracuse University. And actually, it was during those years that Doug actually did some of the original groundbreaking economic work on the subject that we're going to be talking about today. So this makes him incredibly qualified to discuss with you. And Doug, let me just hand the microphone over to you. The program is yours.
Well, thank everyone for coming today, and I especially want to thank Dick for the glowing, if not probably accurate, introduction. I'm really sure that not everybody on both sides of the aisle remembers my tenure at CBO fondly, and I'll give you the list after lunch. It's also important to recognize that all the things Dick said notwithstanding, the real reason that this paper is before you today, and the real reason that is of the quality that it is my co-author Cameron Smith, who's sitting next to Dick, and I would encourage you to go talk to the real brains and effort in the operation at the American Action Forum. The genesis of this paper is not just the interest I've had in this topic for a long time, but the state of the U.S. economy. We have an economy that has, in fact, been growing for about a year. My own view is that if you strip out a lot of the temporary factors, the census hiring, firing, the inventory swing that we saw, the cash for clunkers program, some of the tax credits for housing, which then spill back into housing construction, the appliances that go into houses, and the manufacturing sector in general, that instead of the picture that many people have been given, which is an economy that started out sort of relatively quickly and then tapered off a bit, the bad news is that instead it's just never been very good. We've been grinding along at something like 1.5%, 2% the entire time. That's the trend rate of growth, and that's unacceptably slow for the Americans who are out of work and for the needs of generating prosperity for the next generation. To my eye, then, everything that the Congress and an administration ought to be focused on should be the growth consequences of the things they do. and that we should have a relentlessly pro-growth attitude toward policymaking in the United States. Now, many people would not think of the estate tax as part of that conversation, as having anything to do with growth policy. They instead cling to an older image of the estate tax, which is sort of a benign instrument for social justice, which, at the demise of the owner, swoops up those assets, distributes them to the less affluent in society, and there's no real consequence to that activity except that the dead person doesn't know, and the people who get the receipts feel better. The sad truth, however, is that cumulative research, not mine alone, but many people's research, has in fact reversed that image of the estate tax and properly now views it as a tax with serious economic consequences. It is a tax on capital. When we give up the opportunity to consume something and live better in the present, put it away in the form of productive capital, we have undertaken the fundamental activity which generates growth. The estate tax is a tax on the outcome of that activity and has economic consequences as a result. And the paper summarizes some of the literature which has brought us to this understanding. But the most important thing to recognize is that it is not just the estate tax that is written down in the law at the moment, at the sad passing of some entrepreneur or small business owner. It is, in fact, the estate tax that is in place while they are in the prime of their careers, in the 40s and 50s. And this is work that Joel Slemrod has done, made it pretty obvious that people form their expectations of what's likely to happen over the remainder of the life of their business at that time. They, as a result, are influenced in their decision-making by the taxes that are placed in that time. And so what we do now has consequences for years to come. And Dick described there's an extraordinarily active debate. That debate is about tax policy in the end, and tax policy has many components. You have revenue needs, you have desires for social fairness and administrative simplicity, but on that list for the estate tax ought to be impacts on economic growth, because the evidence is very clear that there will be less wealth accumulation in the presence of a punitive estate tax as opposed to zero or a modest estate tax. And one of the contributions of this paper is the opportunity to literally bury the audience in numbers. So if you turn to the appendix, there are more numbers than you could possibly digest. But what we wanted to do was to not only identify from the research literature the channels by which the estate tax would impact the economy. Wealth accumulation broadly defined. We know some of that will be wealth accumulation within the context of a small and family business. That small and family business will look at taxes on that accumulation and react in ways that the literature makes very, very clear. They will view the loss in the growth of their firm and restrict the number of people they put on the payrolls. They will have a lower probability of actually expanding, that is, putting new payroll on. If they make that decision, they'll do less in the way of increased payroll. And if you're paying everybody the wages you plan to, less payroll means fewer jobs. They will look at the taxes on that capital accumulation, and they will be less likely to undertake a new capital expansion, whether it's a new facility, whether it's an upgrade of their equipment, whatever it may be that would be in their business interest, they'll cut back on. And they do that because when they do the internal calculation that says, how productive does this investment have to be to not just cover depreciation and meet the market rate of return and pay off my borrowing costs, but I'm going to also have to deal with these taxes. Too many investments flunk that test because of the tax burden. So we know these channels are out there. We know that they're important to the people who actually run businesses, and we're fortunate to have today people who really understand the estate tax, not in a spreadsheet-sensitive way, but because they live their lives faced with it. But we wanted to give the Congress and give the people in this room and give the research community a guide to how big the impacts might be. So we took the literature and we used the estimates that come from that, and we did our best to quantify in all the channels that we think are important: capital expenditures, internal rates of return, things economists call the cost to capital, a calculation done, in the paper, probability of making a new hire, the payroll expansion that you might have, and in the end, the jobs at stake in the small business world as we move the estate tax up and down. So the leading display, which is in the summary, is just a table which gives you a flavor of what we tried to do. Take the estate tax from 0, its current value, to as high as 65%, proposal by Bernie Sanders. What are the ultimate job consequences to the small businesses that are impacted in terms of jobs lost? And you can pick out of that menu both what may be your preferred rate for the estate tax, but you also know that when you do that for whatever reasons, whether they be revenue, whether you believe the increasingly thin evidence that this actually is successful in redistribution, whatever your reasons for doing it, know that you also have economic consequences in the terms of jobs. And for some people, they'll want the other impacts. They'll want the payroll tax or the payroll size. They'll want the capital expenditures. Because when you do that, you push the repercussions down the line, and that is the other insight that is often forgotten. The estate tax is not paid by the decedent. When the estate tax reduces the number of jobs, when the estate tax reduces the wages in the jobs that are available in a small business, the burden is shifted to the workers who would otherwise have been hired or otherwise would have higher wages. When it reduces the capital expenditure, that burden gets shifted down the line to the sellers of durable equipment in this economy. So that we cannot kid ourselves and lose sight of the economics of taxation, which say that ultimately taxes are borne by people through market transactions, and the estate tax is no different from other taxes in that regard. So we are thrilled to have worked with the American Family Business Foundation on this effort. It is there as a guide to the consequences of actions, and we are certainly interested in seeing how the Congress acts, but I would be delighted if they acted in an informed manner, and this is part of that effort. Thank you.